In this video, we're going to discuss transfer pricing and tax avoidance. So corporations use transfer prices to try and shift their income to low tax jurisdictions, thereby reducing the amount of tax that they actually have to pay. This is a serious issue with international taxation. You've probably read about it in the news before. Companies trying to shift profits to some country where they aren't taxed at all, or they're taxed at a very low rate, with tax havens and so forth. And then it's also an issue with state and local taxation. So I'm going to give you an example. I'll actually walk you through a real-life legal case from the United States that had to do with state and local taxation. So we have 50 states in the U.S., and it was a deal with South Carolina and the shifting of income. So it was a toy company called Toys R Us. It was very popular in the 1980s in the U.S., and that's when this legal case took place. So Toys R Us, they had a location, multiple locations in South Carolina, and they were expected to pay corporate income tax. So they had to pay state income tax. And let's just say hypothetically that their profits were, let's say, $80 million before considering any royalty expenses. I'll explain where that's important in a minute, but let's just say that that was their profit. I don't know their actual profit, even haven't read the case decision, it doesn't say, but let's just say it was $80 million. Now, what Toys R Us did, so they're a retailer, and they had stores where they sold, physical locations where they sold toys, but they set up another legal entity called Jeffrey. And Jeffrey was actually their mascot for their company, but they set up a separate legal entity called Jeffrey. They're all part of the same company, but they have these subsidiaries and these different entities within the same company. So they had Jeffrey as its own entity, and so Jeffrey had all the trademarks. It had all the trademarks and intellectual property related to Toys R Us. And so to use the name Jeffrey, which is the mascot for Toys R Us had to pay a royalty. They had to pay a royalty. They had to pay licensing fees to Jeffrey. Okay, again, so we've got two entities here. Toys R Us is the physical stores, the retailer, and they're paying a royalty to Jeffrey, who holds the intellectual property, the trademarks for the branding. Okay, so now they're having to pay this royalty. And again, I'm just going to make up numbers here. These are not the exact numbers, but let's say that they paid a royalty of $80 million. That was the royalty that they paid. So now, if you see, they would have had $80 million of profit before accounting for the royalty. But now when you deduct this royalty that they're paying, that's an expense, right? So this is an expense, $80 million royalty expense to the Toys R Us. So Toys R Us now has no income, no taxable income. Okay, so no taxable income for Toys R Us. Now you might say, hey, that doesn't matter because Jeffrey is going to get taxed on $80 million of royalty income. Okay, now that would be the case. So that would be correct. So there is $80 million. So it's because you might be saying, hey, we're just taking $80 million and shifting it to a different entity. Why? How does that escape tax? Well, here's the thing. Jeffrey was not located in South Carolina. Jeffrey was headquartered in Delaware, in the state of Delaware. These are U.S. states. South Carolina's U.S. state. Delaware's U.S. state. So Jeffrey is in Delaware, where royalty income is not taxed. Corporate royalty income is not taxed in Delaware. So even though Jeffrey has $80 million of income, to Delaware, it's not taxed. Okay, so basically what has happened, and I think this is a simple example to show you how you could avoid. You think about it, instead of thinking about South Carolina and Delaware, think about the United States and Ireland or something. You just think about different jurisdictions where you have the low tax jurisdiction and then you have the high tax jurisdiction, and you're trying to shift profits to the low tax jurisdiction. In this case, Toys R Us was hoping to avoid any tax at all, right? And I think actually the royalty expense was like 1% of their revenues or something like that. I can't remember the exact details, but the idea is they're trying to go from a high tax jurisdiction to a low tax jurisdiction. They're shifting the profits. But you can see this is just on paper. This doesn't, come on, Jeffrey's a separate entity and it holds the trademarks and it just so happens to be located in a state that doesn't tax royalty income. This was designed to minimize the amount of tax that Toys R Us had to pay. Now, incidentally, Toys R Us ended up losing this case and had to pay tax. But very frequently, corporations are able to do this type of strategizing and minimizing their tax liability using transfer prices in a very similar way to this. Again, not just with state and local taxation, but on a broader level, at international level, finding low tax countries that are tax havens, where they either don't tax income or they tax it at a very low rate, and the companies are trying to figure out how do we shift those profits to those jurisdictions to avoid or minimize the amount of tax they have to pay.